Imagine ordering a ride and a driver never appears because there is no driver. A fleet of Teslas shows up, drives itself, and charges while you sleep. Musk says that's the future. Investors call it the next multi-billion-dollar business. But there's a brutal question. Can Tesla actually pull it off? Today we'll unpack the Robotaxi bet. What Tesla claims, what must be solved, and why this could either remake cities or blow up on the balance sheet. I'll give you 3 deadly bottlenecks to watch that decide everything. Elon Musk frames robotaxis as the logical next step. Cars that earn when they're idle, a lower cost per trip, and a new service revenue stream far beyond car sales. Tesla's roadmap mixes its full self-driving software, fleet management, and eventual robotaxi launches. Sounds simple, right? Make the car, make the software, flip a switch, but it's not. First bottleneck, perception. Self-driving isn't one single skill, it's thousands of tiny edge cases. Unusual pedestrians, bad weather, construction zones, ambiguous intersections. Current systems can handle common scenes. The rare ones break them. To run a robotaxi fleet, you need far higher safety margins than the driver assist systems in consumer cars. That means exhaustive testing, redundancy, and human review. That costs time and money, lots of it. Second bottleneck, regulation. Cities and national regulators set the rules on safety, liability, and insurance. A single severe incident could stall approvals for years. Regulators don't license trials the way Silicon Valley hopes. And who is liable if a robotaxi crashes? The manufacturer, the operator, the software vendor. Until laws clarify liability and insurers can properly price the risk, large-scale deployment is an uphill legal fight. Third bottleneck, unit economics. Robotaxis must be cheaper per ride than human-driven services while covering capital expenditure, maintenance, charging, software, and liability insurance. If the marginal cost per mile stays high, the business never scales profitably. Tesla claims software will amortize the hardware cost. That's optimistic. Real fleets need near-perfect utilization rates, cheap energy, and low downtime. Compounding all of this is competition and infrastructure. Waymo, Cruise, and other deep-pocketed incumbents are already testing in controlled zones. Cities need charging networks, dispatch systems, and parking for idle cars. No single company can unilaterally build that overnight. The winners will be those who combine technology, local partnerships, and regulatory buy, not just the ones with the flashiest demo. If Tesla solves these 3 constraints, safer perception, clear regulation, and sustainable economics, the upside is enormous. Mobility as a service at scale, lower urban congestion, and a huge recurring revenue stream. Cities, rides, and even insurance markets would shift. But if Tesla fails, the cost is real. Billions of dollars of investment wasted, reputational damage, and a prolonged regulatory chill that slows autonomous progress across the entire industry. Failure doesn't mean no progress, it just means a slower, more conservative rollout led by regulated operators. So how do you know if Tesla is on track? Watch 3 signals. 1. Real-world public trials beyond closed test zones. 2. Concrete regulatory approvals and insurance partnerships. And 3. Disclosed data on utilization and unit economics. If these 3 appear, the risk falls. The robotaxi bet is Tesla's biggest strategic gamble after EVs. It could remake cities, but it could also be the place they bury billions. Which outcome scares you most? Safety, regulation, or the money? Comment 1, 2, or 3 below. Subscribe, we cover the wins, the fails, and what they teach us every day.